Buying the wrong house is not just a financial mistake. It can trap you in a property you cannot sell, cannot insure, and cannot afford to fix. This is not about taste or preference. Every property in this countdown has objective, documented problems that cost buyers tens of thousands of dollars after closing. First-time buyers and seasoned investors alike miss these 10 red flags because they are designed to be invisible until it is too late. Number 10 starts behind the walls of nearly every house built before 1970. In the 10th place, iron and galvanized plumbing hides a costly threat inside the walls of countless homes built before 1970. Galvanized steel pipes, once the standard, corrode from the inside out, often undetected for decades. The EPA estimates that more than a third of older municipal water systems still contain these aging lines. Corrosion narrows the pipe diameter, causing low water pressure, rusty tap water, and eventually leaks that can undermine foundations or trigger mold outbreaks. When a leak is discovered, insurers may add a surcharge or refuse coverage until a full repipe is completed. Mortgage lenders routinely require documented replacement before approving a loan. The price tag for a whole house repipe ranges from $9,500 to $22,000, depending on access and local labor rates. Partial repairs rarely solve the problem, as hidden sections continue to fail. For any home built before 1970, a dedicated plumbing inspection is not optional. It is essential protection against inheriting a silent five-figure liability. Number 9, knob and tube and aluminum wiring create a hidden electrical hazard that many buyers overlook until it is too late. Knob and tube, found in homes built before the 1940s, lacks grounding and uses cloth insulation that degrades over time, raising the risk of electrical fires. Aluminum wiring, popular in the 1960s and 70s, oxidizes at connections, which can lead to overheating and arcing. Insurers routinely refuse to cover homes with these systems until a full rewiring is completed. Some lenders will not approve a mortgage unless the wiring meets current code. The costs of replacing knob and tube wiring can easily reach $10,000 to $20,000, with larger homes pushing even higher. Aluminum wiring remediation, if accepted, still runs several $1,000s. Policies often contain explicit exclusions for electrical fire loss when these systems are present. Before moving forward, buyers should pause and budget for a full electrical inspection and potential rewiring. Without it, both insurance and financing may be out of reach. 8th place, flat roofs in high rain or snow climates are a hidden liability for homeowners. Unlike pitched roofs, flat designs trap water, leading to ponding and accelerated membrane failure. Roofing industry surveys find that nearly 15% of flat roofs over 20 years old show visible signs of water pooling and surface delamination. In wet or snowy regions, the replacement cycle shortens dramatically, and owners face full membrane replacement every 10 to 15 years, with costs ranging from $9,000 to $16,000 per job. Insurers treat these roofs as high risk, routinely adding surcharges of 30 to 50% to base premiums, especially in areas with more than 30 inches of annual precipitation. Many lenders require a roof condition certification, and buyers often inherit a property that needs immediate repair just to secure coverage. Before making an offer, demand a specialized roofer's inspection and request written documentation of any prior leaks or insurance claims. Number 7, fire damaged homes carry a risk that lingers long after the flames are gone. Even when a property looks restored, the aftermath often hides charred framing, warped structural members, and heat-damaged wiring behind new drywall. Restoration contractors routinely see repair invoices climb from $75,000 to $150,000 for a standard single-family house, especially when smoke and water reach the attic, crawl space, or electrical system. Insurers treat any home with a documented fire loss as high risk. Many refuse to write a policy within 3 years of the event, or they add a surcharge of 30 to 50% above the base premium. Policy language may even exclude coverage for future losses if any hidden damage remains unrepaired. Mortgage lenders flag these homes for additional inspections, and buyers face higher deductibles and stricter loan conditions. Before considering any property with a fire history, demand a full forensic report that documents the extent of prior damage and confirms all repairs meet current code. Anything less leaves you exposed to catastrophic future costs and insurance denial. Number 6. Houses with major structural problems pose a threat that goes far beyond cosmetic flaws. Foundation settlement, cracked slabs, and shifting load-bearing walls signal deep instability, often invisible during a casual walkthrough. When a structural engineer documents differential settlement greater than half an inch, the repair path usually leads to underpinning, slab jacking, or even full reconstruction. These engineered repairs routinely cost between $30,000 and $80,000, with invoices itemizing steel piers, concrete pours, and soil stabilization. Mortgage lenders treat unresolved structural issues as a deal breaker, frequently denying loans outright or requiring a repair escrow until a licensed professional certifies the property is sound. Insurance carriers may also refuse coverage until repairs are complete, leaving buyers unprotected. Before making any offer, insist on a full structural report from a state-licensed engineer and obtain lender pre-approval that specifically addresses structural integrity. Without these safeguards, buyers risk inheriting not just a house, but a six-figure liability. Number 5. Houses located in FEMA-designated flood zones come with a built-in annual expense that most buyers underestimate. Federal law requires homes in Zone A or Zone AE to carry flood insurance through the National Flood Insurance Program. Under FEMA's Risk Rating 2.0, premiums are recalculated based on individual property risk. Typical policies now run between $1,000 and $3,000 per year, but in high-risk areas, premiums can spike to $10,000 or more, especially after a major flood event. Many owners have seen increases of 40% to 400% over previous years, with no cap on future hikes. Lenders will not close on a mortgage without proof of a current National Flood Insurance Program policy, and buyers must often provide an elevation certificate, which can cost $500 to $2,000 just to get a quote. Elevation or mitigation work, such as raising the structure or installing flood vents, can add another $30,000 to $80,000. Unlike a one-time repair, this is a recurring cost that can escalate without warning. Before making an offer, always request a written National Flood Insurance Program premium estimate and a current elevation certificate. A seemingly affordable home can become a financial trap when annual insurance costs outpace the mortgage itself. Number 4. Houses with septic systems in neighborhoods served by municipal sewer lines carry a hidden regulatory risk that can blindside buyers. Local ordinances increasingly require homeowners to abandon their septic tanks and connect to the public sewer, often with little warning and a strict compliance deadline. Conversion is not a minor upgrade. The typical cost to decommission a septic system and install a new sewer lateral runs between $10,000 and $20,000 depending on distance, terrain, and permit fees. In some cases, municipalities impose penalties for non-compliance or even place liens on the property until the work is done. The Environmental Protection Agency reports that 24% of U.S. counties still lack full sewer coverage, but in growing suburbs, forced conversion is becoming the rule rather than the exception. Before closing, buyers should verify local sewer mandates and demand that sellers either complete the hookup or place funds in escrow to cover the full cost. Ignoring this step turns a seemingly manageable home into a five-figure liability overnight. Number 3. Houses with unpermitted additions or conversions can unravel a deal before it ever closes. Any room, deck, or garage apartment built without proper permits is treated as if it doesn't exist when an appraiser values the property, meaning thousands of dollars in square footage simply vanish from the loan calculation. Mortgage lenders routinely cut the approved loan amount or demand that all unpermitted work be demolished or brought up to code before funding. According to a 2023 NCAT survey, buyers face remedy costs ranging from $5,000 for minor corrections to $30,000 or more for major retrofits, code upgrades, and permit fees. Municipal code enforcement can issue fines or even require the removal of the entire addition, and title insurers may refuse to cover future legal disputes over the work. Before making an offer, pull the property's permit history and get written estimates for legalizing any questionable construction. Overlooking this step can turn a so-called bargain into a costly legal and financial liability. Number 2, houses with active mold or chronic moisture problems are a health and financial minefield. The EPA sets the threshold for indoor mold risk at just 60% relative humidity, yet routine inspections reveal hidden mold in nearly a quarter of homes built before 1980. Remediation isn't a simple cleanup. Professional removal, containment, and clearance testing by a certified industrial hygienist can cost anywhere from $10,000 to $30,000, depending on the scope. Most insurance policies now exclude mold-related claims outright, leaving owners to shoulder the full cost of repairs and any resulting health lawsuits. Mortgage lenders require not only proof of remediation, but also a formal clearance report before funding a loan. Chronic moisture means recurring expenses, with leaks and humidity often returning after cosmetic fixes. Always demand a certified mold inspection before closing. Without it, buyers risk inheriting an uninsurable, unsellable home and a liability that can escalate for years. And finally, in first place, leasehold properties with escalating ground rent present a financial trap hidden in the fine print. On paper, a home may seem like a bargain, but the ground rent can double every decade. What starts as $200 a year can balloon to $6,400 by the time you are ready to sell. Lenders often refuse to finance any leasehold with less than 30 years remaining, and major insurers follow suit. Buyout demands for the land itself routinely run $5,000 to $10,000 due in full before you can refinance or transfer title. True Guide and MGIC underwriting manuals confirm that a short or rapidly escalating lease kills most conventional loans, stranding owners with a property that cannot be sold or mortgaged. Always have a real estate attorney review every leasehold document before you commit. Overlooking a single clause can turn a discount home into a financial anchor for decades. Across all 10 traps, one reality stands out. The true cost of a house is buried in risks most buyers never see. Sellers won't warn you, and disclosures miss what dedicated inspections reveal. In real estate, what you don't know isn't just expensive, it's dangerous. Stay smart, stay protected.